They declared it unattainable. They insisted that $75 represented the absolute zenith. They predicted that financial institutions would fiercely defend that threshold with every resource at their disposal. However, today, on the 26th of December, the marketplace has rendered a judgment that will resonate throughout financial annals. That barrier has been breached. Observe your displays. The price of silver is currently trading at $75.60. We have not merely approached the resistance level, we have obliterated it. We concluded the trading week at its apex. For the preceding 3 years, $75 had been the definitive demarcation. It was the price point at which every upswing faltered and expired. It was the level where the major banking entities would impose substantial short positions to suppress market sentiment. Nevertheless, today, their algorithmic strategies have collapsed. Today, the sellers were overwhelmed by an inexorable torrent of purchasing power that simply refused to abate. In this urgent market commentary, we will meticulously dissect the events that have transpired. We will elucidate why surpassing the $75 mark initiates a quantifiable phenomenon known as a gamma squeeze. We will examine the weekend predicament confronting short sellers who now find themselves in an untenable position. Furthermore, we will equip you with the knowledge necessary to anticipate forthcoming developments. The breakout is definitively confirmed. The former ceiling has transformed into a foundation and the pursuit has commenced. To fully comprehend the significance of this advance, one must consult the calendar. It is Friday, December 26th. The majority of the globe is engaged in festive observances. Trading operations in London and New York are functioning with minimal personnel. Transaction volume is notably low. Typically, the major banks leverage this subdued volume to depress asset prices. They utilize this quiet trading period, often referred to as Ghost Week, to manipulate chart appearances, portraying a downward trend to undermine investor morale prior to the commencement of the new fiscal year. However, today, the antithesis occurred. Instead of a decline, we witnessed a surge. The underlying cause? The demand for physical metal did not observe a holiday. The industrial consumers situated in Asia, the sovereign investment funds, and the discerning individual investors perceived the limited liquidity not as a hazard, but as a strategic opening. They recognized that with the senior risk managers of the banking sector absent, the defenses were unguarded. Consequently, they exploited this vulnerability with decisive action. The movement to $75.60 has generated a substantial weekly price candle. An examination of the chart reveals that the week's closing price is situated at the extreme upper boundary of the trading range. This represents the most potent bullish technical indicator attainable. It signifies that buyers were prepared to retain possession of the asset through the weekend, disregarding potential risks. Their apprehension was not centered on the market's close, but rather on the prospect of being excluded from further gains. Now let us delve into the technical intricacies surrounding the $75 level. What rendered this price point so formidable to surmount? The answer lies within the options market. A substantial volume of call options representing millions of ounces of silver were positioned at the $75 strike price. The market makers, which are the financial institutions that underwrote these options, had calculated on silver remaining below that particular line. As long as the price remained at $74, their exposure was contained. However, the instant the price ascended beyond $75, their exposure became critically detrimental. When an option moves into the money, the entity that sold that option is obligated to deliver the underlying asset. To mitigate their risk, the market makers' automated trading systems are compelled to engage in hedging activities. This involves entering the futures market to acquire silver contracts. This practice is known as delta hedging. This process establishes a self-reinforcing cycle. The price reaches $75.10. The automated system, reacting to this perceived threat, procures futures contracts. This buying pressure propels the price to $75.30, which in turn necessitates the automated system to acquire even more futures. This dynamic is the essence of a gamma squeeze. It is a compelled buying event driven by mathematical imperatives rather than investor sentiment. The reason for the rapid ascent to $75.60 this afternoon is attributable to these automated systems chasing their own trading actions. They were obligated to become purchasers precisely at the moment they sought to divest. Furthermore, given the diminished liquidity on Boxing Day, there were insufficient sellers available to absorb these purchases. Consequently, the price was forced to gap upwards to locate additional trading partners. We have now entered a phase where the financial institutions are inadvertently fueling the very price appreciation they endeavored to prevent. Recall the anxieties leading into the Christmas holiday last week. The major banks were holding significant short positions, a situation that engendered considerable apprehension. History has essentially repeated itself today, albeit with amplified consequences. Envision the position of a short seller as they depart for the weekend on this Friday evening. They had previously sold silver at $72. Now, the price stands at $75.60. Their leveraged position has incurred a loss of $3.60 per ounce. The market is scheduled to be closed for a 48-hour period. They must endure the entire weekend contemplating the potential market reactions in Asia on Sunday evening. They must consider the possibility of a significant price increase in Shanghai, potentially reaching $80. They must also contemplate the impact of any geopolitical news event that could cause both oil and silver prices to surge dramatically. This constitutes a profound psychological ordeal. When trading resumes on Sunday evening, these trapped short sellers will have a singular objective: self-preservation. They will seek to liquidate their positions at the earliest available price. This action inherently establishes a fundamental support level for the market. Any retracement in price will be met with buying activity from desperate short sellers attempting to exit their positions. This phenomenon contributes significantly to the resilience of bull markets. The demand generated by short covering acts as a crucial safety net. Moreover, it is imperative to consider the broader global context. In our preceding report, we discussed the influence of the Shanghai market, which has been trading at prices nearing $80. In contrast, the New York market was lagging at $72. Today's movement to $75.60 signifies simply that New York is now converging with the Asian price. The arbitrage differential was excessively pronounced and unsustainable. There was an accelerated eastward flow of physical metal. Consequently, the New York market was compelled to elevate its bid price to staunch this outflow. We are now approaching parity with the price in China. However, complete equalization has not yet been achieved. If Shanghai is trading at $80 and our current price is $75.60, there remains a disparity of $4.40. This gap represents a vacuum that will continue to exert upward pressure on the United States price until the two markets achieve equilibrium. Therefore, do not perceive the $75.60 price as indicative of an overbought condition. Relative to the physical market in Asia, it still represents a discount. We remain the most cost-effective location globally for acquiring silver. As long as this price advantage persists, purchasing activity will continue unabated. Let us address the prevalent apprehension. I acknowledge that observing this chart, characterized by a vertical trajectory, may induce a sense of unease. The perception of a rapidly ascending price may lead to the expectation of an imminent collapse. Indeed, the speed of the ascent is considerable. However, within the context of a supercycle, this is an inappropriate reaction. Markets that successfully breach multi-year bases, such as the cup and handle formation we previously examined, often exhibit accelerated and more significant price movements than initially anticipated. They enter a sustained trending phase. In such trending phases, indicators of overbought conditions lose their predictive efficacy. The relative strength index, RSI, may remain elevated and the price may consistently trade above its moving averages. Attempting to initiate short positions in this market based on its seemingly high valuation is akin to positioning oneself directly in front of an oncoming freight train on the assumption that its speed is unsustainable. While it is indeed moving at a high velocity, that is precisely why one should not obstruct its path. The ascent to $75 fundamentally alters the psychological outlook of the average investor. At $60, skepticism prevailed. At $75, curiosity is now evident. By $80, greed will likely become the dominant sentiment. We are transitioning from a phase of pronounced skepticism to one characterized by the fear of missing out, FOMO. It is within this FOMO stage that the most substantial capital gains are typically realized. Nevertheless, adherence to disciplined trading practices remains paramount. Technical analysis indicates that when a significant resistance level is decisively broken, a subsequent retest of that level is a common occurrence. The former resistance acts as a new support. Therefore, as we approach the forthcoming week, do not be surprised if we observe a retracement of the price back to the $75 mark. Similarly, do not be astonished if the price touches $74.80. Such movements are healthy. They represent the market's attempt to validate the authenticity of the breakout. It is the market's way of ensuring the stability of the newly established floor. Should the price retreat to $75 and subsequently rebound, this would constitute a definitive buy signal for the decade. It would unequivocally confirm that the prior resistance has been permanently overcome. Consequently, if you observe downward price movements on Monday or Tuesday, maintain composure. Focus on the critical $75 level. As long as the price remains above this breakout zone, the established trend remains intact. The major financial institutions will likely attempt to engineer a price correction to precipitate a sell-off. Their objective is to induce investors to divest their holdings, thereby enabling them to cover their short positions at a lower cost. Do not afford them this satisfaction. Furthermore, it is essential to examine the intricate dynamics that will unfold in the coming week, as it is not merely an ordinary week, it marks the conclusion of the calendar year. It is a period characterized by window dressing and tax loss selling strategies, all of which contribute to the setup for the anticipated January effect. We will conduct a thorough analysis of the year-end closing price. If silver concludes the year at $75, this will serve as a compelling signal to every pension fund globally. It will unequivocally designate silver as the preeminent performing asset class of the year, thereby compelling these funds to allocate capital to it in January. The prevailing market conditions are demonstrably favorable. The countdown is underway for a substantial influx of institutional capital. Let us now examine the flow of financial resources. It is imperative to address the movement of institutional investment capital. While we frequently focus on the individual investor or the industrial consumer, there is a significant and previously unaddressed participant in this market, the fund managers. It is the close of December, a period that, in the financial world, is synonymous with performance evaluations. Every hedge fund, mutual fund, and pension fund is obligated to produce their year-end financial statements. They must furnish their clients with reports detailing their portfolio holdings and investment returns. Imagine the position of a fund manager. Throughout the preceding year, they largely disregarded silver, dismissing it as an insignificant asset. Their investment focus was primarily directed towards technology stocks and bonds. Now, as they review their performance metrics, they observe that silver has emerged as the highest performing asset class of the year, exhibiting substantial gains and having just broken through the $75 resistance level. To present a year-end report to their clientele that indicates no exposure to silver would convey an impression of professional incompetence. Their clients would inevitably question the rationale behind missing out on what has proven to be the most significant market rally of the decade. Consequently, what course of action do these managers undertake in the final days of the year? They engage in window dressing. This involves the urgent acquisition of assets that have demonstrated strong performance. They will purchase silver at the current $75 price point simply to ensure its inclusion on their balance sheets by December 31st. Their objective is to be able to assert, observe, we are invested in silver. We participated in this significant market advance. This artificial demand generates upward momentum as the year concludes. It represents a form of purchasing driven by a desire to maintain professional reputation rather than by fundamental valuation considerations. However, irrespective of the motivation, it invariably contributes to an increase in the asset's price. This institutional manifestation of FOMO poses a significant threat to short sellers, as these funds do not acquire a handful of contracts. They purchase in the thousands. Their purchasing decisions are largely insensitive to price fluctuations. Their primary requirement is to establish the position. Therefore, as we transition into the upcoming week, anticipate the execution of unsolicited, large volume buy orders hitting the trading tape. This represents the sound of Wall Street institutions attempting to salvage their professional standing. Now let us reorient our focus to the physical commodities market. While the paper trading price is celebrating at $75.60, the physical market is experiencing extreme strain. We are receiving reports from major bullion dealers indicating critically depleted inventories. The anticipated Boxing Day sales did not materialize. Instead, dealers have increased their premiums. The reason for this escalation is their inability to replenish their stock. If a dealer sells a silver eagle coin today, they must acquire a replacement from a wholesale supplier. However, these wholesalers are currently closed for the holidays, and the refineries are operating with substantial backlogs. Consequently, the dealer assumes considerable risk by completing sales today. Should silver experience a price surge to $80 on Sunday, the dealer would incur a financial loss on every coin sold on Friday. To mitigate this potential exposure, they have widened their bid-ask spread. While the spot price is quoted at $75.60, the asking price for a physical ounce is likely exceeding $90. We are rapidly approaching the $100 psychological milestone for physical silver. Consider this. We are nearing a triple-digit valuation for the actual metal. This divergence is critically important to comprehend. It signifies that the spot price is not accurately reflecting the prevailing market realities. The spot price is akin to a malfunctioning thermometer. It may indicate 70 degrees, while the actual room temperature is significantly higher, perhaps 90 degrees. Eventually, either the thermometer will fail or it will accurately reflect the true temperature. The latter scenario implies a substantial, rapid upward movement in the paper market to align with the prevailing street price. Let us now examine the mining sector. At a silver price of $75 per ounce, silver mining companies transform into highly profitable entities. For a company such as First Majestic or Pan American Silver, their production cost per ounce is estimated to be between $20 and $25. At a selling price of $75, they are generating a profit of approximately $50 per ounce. This profit margin is exceptionally high, representing a level that technology companies can only aspire to achieve. However, if we examine the stock charts of these mining companies, we do not observe a corresponding threefold increase in their share prices. While they have experienced gains, their performance has lagged behind that of the underlying metal. This represents an opportunity gap. Generalist investors have not yet fully grasped the financial implications of this scenario. They continue to perceive the mining industry as inherently problematic. However, when the fourth quarter earnings reports are released in January and these companies announce record profits, substantial dividend payouts, and aggressive share repurchase programs, the stock market will inevitably recognize this discrepancy. We are presently establishing the conditions for a significant catch-up trade within the mining sector, which has the potential for explosive growth. If silver maintains its price above $75, the mining index would need to double its current valuation to achieve fair market value. This is where substantial leverage is present. While acquiring physical silver serves to preserve wealth, investing in the appropriate mining stocks has the potential to multiply it. We must now consider the geopolitical catalysts that could further accelerate this trend. The BRICS nations, Russia, China, and India, are closely monitoring this price action. They are the primary holders of physical silver inventories. As the price escalates, their respective balance sheets strengthen. Concurrently, as the US dollar weakens, the financial position of the United States deteriorates. This represents a significant transfer of global economic power. There are unsubstantiated reports, and I emphasize that these are merely rumors, suggesting that China is preparing to unveil a new trade settlement system in the year 2026, which would be backed by natural resources. If they were to link the renminbi to gold or a basket of commodities, including silver, this would effectively remonetize the metal, transforming it from a mere commodity into a form of currency. In a global economic environment where silver functions as a medium of exchange, a price of $75 would be considered nominal. Historically, when silver served as currency, a full day's labor would be compensated with silver coinage. An ounce of silver could purchase a suit of clothing or sustain a household's food requirements for an entire week. When adjusted for current inflationary levels, the equivalent purchasing power of an ounce of silver would translate to hundreds of dollars. We are only beginning to incorporate the monetary premium into silver's valuation. Currently, silver is priced primarily as an industrial metal experiencing a supply deficit. It has not yet been priced as a global reserve currency. When this fundamental shift in perception occurs, the trajectory of its price chart will become logarithmic. Let us revisit the mechanics of the short squeeze. We have discussed the gamma squeeze, but it is also crucial to consider the substantial short positions held by commercial entities. The major financial institutions continue to hold net short positions representing millions of ounces of silver. They are currently experiencing billions of dollars in mark-to-market losses. They face two strategic options: either to double down by selling additional paper contracts in an attempt to drive the price lower, or to capitulate by repurchasing their short positions and converting them to long positions. If they opt for the latter, the effect would be akin to adding fuel to an already raging inferno. The combined buying pressure from financial institutions, industrial consumers, individual investors, and pension funds would create a confluence of demand akin to a quadruple witching event. This demand surge is converging on a market characterized by extremely limited liquidity during this ghost week. This explains the occurrence of price gaps and the phenomenon of price teleportation. The underlying pressure is simply too great for the existing infrastructure to contain. The system is on the verge of collapse. Now, a word of caution regarding counterparty risk. When you acquire silver through an exchange or an exchange-traded fund, ETF, you are placing your trust in a counterparty to fulfill its delivery obligations. You are relying on the assurance that the financial institution actually possesses the physical metal. In a stable market, this arrangement is generally secure. However, in a compromised market, such as the one evidenced by the significant price disparity between New York and Shanghai, this presents a potentially fatal vulnerability. If the banking institutions deplete their silver reserves, they may declare force majeure, stating that due to extraordinary circumstances, we are unable to fulfill our silver delivery obligations. We will provide a cash settlement instead. In such a scenario, they would compensate you with $75 in cash, while the actual market price of silver might have escalated to $100. You would forfeit the potential for further gains and remain trapped in fiat currency. This is the paper trap. The sole method to circumvent this risk is to personally hold the physical metal or to secure it in a fully allocated non-bank vault facility that you can personally access. If you do not possess the physical asset, you do not truly own it. And in the current market environment, ownership is of paramount importance. Let us re-examine the currency aspect. The US dollar index is exhibiting signs of instability. However, silver is appreciating against the dollar. It is also rising in value relative to the euro, the Japanese yen, and all other major currencies. This is not solely a narrative of dollar weakness. It represents a broader failure of fiat currencies. The global realization is dawning that all paper currencies are being systematically devalued to service mounting debt obligations. Consequently, there is a discernible flight towards assets that cannot be arbitrarily created. Gold has led this charge, reaching a price of $4,500. Silver is now following suit, exhibiting characteristics of a high beta version of gold. When gold advances incrementally, silver experiences a more significant upward movement. When gold surges, silver achieves flight. We are currently experiencing this accelerated phase of silver's appreciation. Therefore, what action should you consider over this weekend? The financial markets will be closed. You have a choice. You can passively observe the trading screens, experiencing anxiety about the upcoming Sunday market opening. Alternatively, you can adopt a broader perspective. Examine the monthly price charts. Observe the formation of the cup and handle pattern. Consider the persistent supply deficit. Analyze the price levels in Shanghai. All indicators point towards a sustained upward trend. The volatility experienced during Ghost Week is merely transient noise. The underlying trend is the definitive signal. Do not permit a temporary price decline to compel you to divest your holdings. If the major financial institutions manage to depress the price to $72 on Monday, consider it an exceptional opportunity. It represents a discounted price for an asset that is rapidly approaching obsolescence in its current valuation. At $72, the physical metal would become even scarcer. The lower the price falls, the greater the strain on vault inventories becomes. Conversely, the higher the price ascends, the more potent the FOMO effect becomes. In either scenario, the major financial institutions are placed in a losing position. They are in a state of checkmate, though they have not yet formally conceded defeat by removing their king from the board. We are witnessing the culmination of an era of price suppression. For 4 decades, efforts were made to keep the price artificially low. Now the submerged object is rapidly surfacing, and its ascent is striking them forcefully. As we approach the final days of the year 2025, prepare yourself for an intensification of psychological warfare. They will assert that this is a speculative bubble. They will proclaim that the rally is over. Their objective will be to persuade you to sell. Disregard these pronouncements. Examine the price levels in Shanghai. Observe the elevated premiums. Note the depletion of vault inventories. These factors represent the undeniable truth. All other narratives are extraneous distractions. Maintain your position. A significant transfer of wealth is in progress, and you are positioned to benefit from it. In the concluding section, we will outline specific price targets for January. We will address the $80 milestone and provide a definitive checklist to ensure your preparedness for the new year. Remain attentive. The most significant gains are yet to be realized. Let us consider the immediate future. We are approaching the weekend. Typically, weekends provide an opportunity for the market to stabilize. However, in a period of exponential price acceleration, weekends often serve as an accelerant. The rationale behind this phenomenon is that information disseminates more rapidly than markets can respond. Over the ensuing 48 hours, conversations will proliferate. These discussions will occur at festive gatherings and family meals. Did you observe the price of silver? Did you see gold reach $4,500? This informal dissemination of information exerts a powerful influence, generating a wave of pent-up demand that accumulates like water behind a dam. When the markets reopen on Sunday evening, this dam will inevitably break. We must discuss the potential for a significant price gap on Sunday. Given that we closed the trading week at our highest point, $75.60, there is a substantial probability of opening significantly higher on Sunday. The Asian markets will be the first to react. They will acknowledge the strength demonstrated in New York and will attempt to anticipate the Monday opening by front-running it. It is plausible that silver could be trading at $77 or even $78 before you even awaken on Monday morning. This highlights the inherent risk associated with attempting to precisely time market movements. If you were to divest your holdings at $75 with the intention of repurchasing them at $74 and the market subsequently opens at $78, you would be effectively locked out of the opportunity. You would then be compelled to chase the price upwards, which would further fuel the rally. This underscores why a holding strategy is demonstrably superior during a squeeze situation. It effectively eliminates the risk associated with price gaps. You're already participating in the upward momentum. The speed at which the train departs the station becomes irrelevant. Now let us examine the $80 mark as a significant price magnet. From a technical perspective, once the $75 level is decisively breached, there is minimal resistance encountered until the $80 level is reached. $80 represents a substantial, round number, and it serves as the next important psychological benchmark. In a market characterized by a severe shortage of sellers, prices tend to be drawn towards these significant price levels. I am of the opinion that $80 is not merely a possibility next week, but a high probability. The momentum is too robust, the trading volume is too substantial, and the underlying shortage of the physical commodity is too pronounced. Furthermore, $80 holds particular significance for another reason. It is the price level at which the mainstream media can no longer ignore the ongoing narrative. At $80, silver will command front-page news coverage. Headlines such as "Silver doubles in a year" or the new gold rush will emerge, drawing in a broad spectrum of participants. We are observing a transformation from a purely financial event into a cultural phenomenon. When an asset transcends its financial role and becomes embedded in popular discourse, its valuation can become detached from fundamental economic realities. Consider the trajectory of Bitcoin. Reflect on the events surrounding GameStop. Silver is now entering a similar viral phase. Let us revisit the influence of China. We are aware that Shanghai is currently trading at a premium, but it is essential to understand the underlying reasons why China is permitting this price escalation. Historically, China has endeavored to suppress commodity prices to maintain low production costs for its manufacturing sector. However, in the present circumstances, they are allowing the price of silver to rise significantly. This indicates a strategic shift in their priorities, placing a greater emphasis on asset acquisition over price control. Their primary concern is securing the physical metal, irrespective of the price paid. This represents a fundamental alteration in national policy, suggesting that they perceive an impending period of geopolitical instability. They are fortifying their national economy, and a robust economy necessitates the accumulation of hard assets. As long as China continues its aggressive purchasing, the support for the silver price will remain strong. You are not merely speculating against the Federal Reserve, you are aligning your investment strategy with the People's Bank of China, which is demonstrably a winning proposition. Now let us turn our attention to the US dollar index. The dollar is currently trading in the vicinity of 98 or 99 points. While it exhibits weakness, it is not experiencing a catastrophic collapse. This is an important distinction. Silver is appreciating in value even though the dollar has not yet undergone a significant decline. This indicates that silver's ascent is driven by its inherent worth, not merely a depreciating currency. But what will transpire when the US dollar experiences a significant downturn? Consider the apprehension among international bondholders during the debt ceiling deliberations in early 2026. A 5% decline in the dollar would act as a potent accelerant for silver, boosting its value due to scarcity and a shrinking base denominator. This dual advantage is what propels commodities to unprecedented heights. We have yet to witness the full impact of this currency tailwind, which represents untapped potential for the current rally's continuation. Let's address the management of price fluctuations. If silver reaches $80 next week, the daily price swings will become more pronounced. A 1% movement at $20 equates to 20 cents, while at $80 it signifies 80 cents. A 5% correction would then amount to $4. It is crucial to recalibrate your expectations. Do not succumb to panic if you observe silver decreasing by $4 within a single day. While significant in nominal terms, this represents a normal percentage fluctuation. Financial institutions will exploit these substantial dollar-denominated movements to sow fear. They will highlight dramatic plunges, such as $4, while omitting the $20 surge experienced just the prior week. Maintain your focus on the overarching trend, not the ephemeral price fluctuations. The trend is undeniably upward. Higher lows are being established and higher highs are being reached. As long as this structural integrity persists, the bullish market remains robust. Now, a brief discussion on the potential for industrial substitution. I frequently hear analysts suggest that at $80 per ounce, industries will transition to copper. While this has been addressed previously, it warrants reiteration. Such a shift cannot occur with sufficient alacrity. Retooling a solar manufacturing facility requires 18 months, and recertifying an automotive safety system takes 3 years. For the next 2 to 3 years, the industrial sector is essentially compelled to comply. They must meet the prevailing price demands, and $80 is far from the threshold of significant disincentivization. For a solar panel, the critical price point is likely in excess of $150. For an automobile, this threshold is over $500. Therefore, concerns about demand destruction at these current levels are premature. We are still within an inelastic price zone where the commodity can essentially double in value, and entities like Samsung will continue to purchase it. Let's examine the outstanding short positions in the derivatives market one final time. The open interest on the COMEX remains elevated. indicating a substantial number of short sellers who have not yet closed their positions. They are holding out for an improbable scenario or regulatory intervention. However, wishful thinking is not a viable investment strategy. With each day that the price remains above $75, their leverage debt grows, ultimately leading to margin calls. When the last resistant bearish position is forced to liquidate, that will signify the peak. We have not yet experienced this climax. Rather, we have witnessed the initial breakout. The ultimate surge is still on the horizon. As we approach the final days of the year, what is the strategic plan? On Monday, anticipate a gap-up opening. On Tuesday, look for a dip followed by a rapid recovery. On Wednesday, focus on the year-end closing price. If we conclude the year above $75, the chart for 2026 will resemble a rocket launch. We are observing a confluence of macroeconomic, microeconomic, and geopolitical factors. This is a once-in-a-century alignment, and you are positioned to benefit. In the concluding segment, we will detail the ultimate strategy. We will discuss methods for safeguarding your physical holdings, the importance of security as your assets appreciate significantly, and provide the essential encouragement needed to maintain your position through this period of intense market activity. Stay engaged. The victory celebration is drawing near. We have arrived at the final portion of this market update. We have analyzed the breakout, exposed the institutional maneuvering, and charted the course toward $80. However, our focus now shifts to a more personal aspect, you. As silver's price escalates to $75 and then to $100, your personal circumstances will change, as will your net worth. But with increased wealth comes not only market-related risks, but also physical security concerns. In this final analysis, Section 4, I will provide a comprehensive security protocol. I will elucidate why discretion is currently the most critical factor in protecting your holdings. I will address the practicalities of securing a high-value asset in an unpredictable environment and offer a definitive recommendation on mentally preparing for the impending wealth transfer. The acquisition phase was the simpler part. The challenge lies in retaining your gains. Let us conclude this. When silver was priced at $20, the presence of a substantial quantity in one's residence was largely inconsequential. Its value was approximately $10,000. It was unwieldy, and its weight made it a deterrent to theft. However, at $75, that same quantity is worth close to $40,000, and at $100, it approaches $50,000. Suddenly, you're not merely storing a heavy commodity, you are safeguarding the equivalent of a luxury vehicle within your personal space. The cardinal rule of the silver surge is silence regarding the silver surge. Do not disclose your holdings to neighbors or colleagues. Refrain from posting images of your collection on social media, especially with location tags. As prices escalate dramatically, desperation often follows. Inflationary pressures can lead individuals to extreme measures. You do not want to be conspicuously identified as a silver holder in your community when economic conditions deteriorate. Emulate the behavior of the gray man. Appear unremarkable, maintain a modest lifestyle, and keep your wealth private. Financial institutions safeguard their gold reserves in highly secure facilities for a reason. You should adopt a similar protective mindset. Your personal security is paramount and entirely your responsibility. We must also consider storage capacity. Silver is voluminous. If you possess a substantial amount and its value triples, your current insurance coverage may become inadequate. Review your homeowner's insurance policy carefully. Most policies have strict limits on the amount covered for precious metals or cash equivalents, often as low as $500 or $2,000. If you're holding $50,000 worth of silver at home, it is highly probable that you are effectively uninsured. This is the opportune moment to assess your security measures. Do you possess a TL30 rated safe, or is your storage merely a basic metal container from a hardware store? If silver reaches $100 per ounce, upgrading your security infrastructure or exploring private vaulting services will become essential. Companies such as Brinks, Loomis, or other private depositories offer secure storage solutions. While these services involve fees, they typically include comprehensive insurance, professional security personnel, and invaluable peace of mind. As your wealth grows, it is imperative to professionalize the management of your assets. Do not allow a physical loss to negate a financial triumph. Now let's address your psychological state. Achieving success can be surprisingly stressful. This may sound counterintuitive, but it is a genuine phenomenon. When you are losing, you operate on hope, anticipating a recovery. When you are winning, fear often takes hold, the apprehension of losing your gains. As silver ascends toward $80, you may find yourself checking your financial data numerous times daily. Each minor downturn could feel like a cardiac event, while each upward tick might offer a fleeting sense of euphoria. This emotional roller coaster can lead to imprudent decisions. It is vital to achieve emotional detachment. Revisit your original motivation for acquiring silver. Was it a short-term speculative gain of a few $1,000s, or was it a strategic decision to shield your family from the erosion of fiat currency? If your objective is protection, the daily price fluctuations become secondary. The quantity of ounces you hold is the primary determinant of your security. Cease calculating your net worth hourly, as this breeds anxiety. Instead, establish price alerts for $80 and then for $85, and subsequently disengage from constant monitoring. Allow the market to operate. Therefore, the verdict on the Boxing Day breakout is clear. The trend is accelerating rapidly. We have broken free from the constraints of the past 3 years. The established financial institutions are retreating, industries are scrambling to adapt, and supply is virtually non-existent. A closing price of $75.60 represents a historic milestone, setting the stage for a dramatic opening next week. Whether we experience a gap-up opening on Sunday or a steady rise throughout Monday, the trajectory is unmistakable. We are heading towards triple-digit prices. This may manifest in January, or it could occur in March, but the underlying economic dynamics strongly suggest its inevitability. The arbitrage gap with China, the burgeoning demand from the solar sector, and the ongoing debasement of monetary policy are all converging into a singular, powerful force. You are positioned at the epicenter of the most significant commodity bull market since the 1970s. You possess the requisite investment, and you have acquired the necessary knowledge. Now all that remains is patience. Enjoy your weekend, secure your holdings, and prepare for the new year, as 2026 is poised to be the definitive year for silver. Subscribe for continued insights.